Hello, everyone. My name is Brendan Rendo, and this is the Orlando Real Estate Buzz. I'm here today with Dionne of Home First Lending, and we wanted to take a moment with the interest rate changes that have happened over the past 6 months and do a little breakdown of what it's done to the purchasing power for people out there on the market today. To give you a little idea, in January of this year, the average interest rate was sitting right around 4%. Okay?
4%, that's really good.
That's a nice rate. And if you look at the history, I went back last night and looked at Ora's history. Over the past 2 years, we've averaged right in that 4% window and actually dipped down below it. So what's happened is mentally, a lot of people have gotten used to that 4% mortgage interest rate. So when they took the little spike up to 4.5%, I won't tell my age, but when I started, we were averaging about 11%. So when you're still seeing 4.5%, you're okay, no big deal. But to a lot of people, because of conditioning, it's a shock, and it was a shock to the system. And I'll go over some other numbers about web searches a little bit later. But have you felt it, that it's slowed down a little bit? The market feels kind of a little bit softer.
It's a little bit, and things like when it was 4 and 4 and an 8 or something, it was right in that range. Nobody questioned. Nobody was just like, oh, I got to find a lower rate.
Right.
Everybody sat there was just like, oh, that rate's too high.
Yep.
But now you've noticed the market's gotten stronger. These rates have ticked up a little bit higher, over 4.5. Now we're sitting closer to 4.75 on conventional loans, and people are, whoa, this is really high.
Exactly.
And that's the story.
Yes.
Like, the crazy part is, let's go back before, 7-8 years ago. These rates are lower than historic before any other time in history.
Very true. Even if you look at the time of the boom in 2005, 6, and 7, interest rates still were at between 6 and 7%. Yeah. And the houses were appreciating, but we had the good old liar loans back then. No more of those. Thankfully, no more of those. So it has been kind of a mental shock. So really, right now in July of 2018, you're kind of looking at 4.75% on a conventional loan.
Absolutely.
How is the FHA compared to this?
So FHA right now is sitting for a buyer that, let's say same credit profile, they're probably right around 4.5.
Okay.
Maybe 4.65 depending on the debt.
Okay.
So, and if you go back a year or more ago, remember that difference between FHA and conventional was a little bit bigger. Mm-hmm. And it's kind of shrunk a lot.
Has it? Okay. So the big thing is to look at is what has this done, this 0.75% change in interest rate increases. What has that done to your purchasing power as a buyer? But also, what has it done as a seller? If you've priced your house and it's been on the market, say, since March or April or even late May, and you've got it priced here because you're in the summer market, things are strong, what has that done, and how do you have to look at, do I have my house priced right now? Can the person who may have looked at it back in January and was waiting, for the end of school, a lot of people wait to the end of school to start their shopping, and they've seen this spike, this increase in interest rates. Maybe they can't afford that house anymore. You got to look at these things. Joseph, why don't you go through a little bit, and let's do a comparison of what someone at 4% could afford versus what someone at 4.75% could afford as far as the purchase price of a house.
Let's try to make this as real as possible. So let's just say, in Central Florida, we're right here in Winter Springs, Central Florida market. Fannie Mae dictates that the average median income for someone in Central Florida is $62,000.
Okay.
It's 62 and some change. But for this purpose, let's just be very, basic. You make $62,000 a year. All right? So let's go into it because nobody just makes money. We all have expenses too, right?
Yes.
Unfortunately. So what are some of the most common expenses? I mean, you know anybody?
Your wife? Wait, I'm
Okay.
sorry. No, I'm sorry.
Well, let's sit there. First off, car. Let's say car payment. I don't think
Okay.
I've done an application. I would say 95% of my applications have a car payment.
Makes sense.
You know, where you're making 62,000, you probably don't have, you know, a Pinto. You don't have a, you know, baseline, but you don't have an expensive car. Let's say you got a gray rate and you put a little down. Your payment's $375 a month.
Reasonable.
Right? Reasonable. You went to college to get that $62,000 a year job. You have
Woo,
student loans. So you see it 90% of lives. So we'll just say as out for student loans. Let's say you know you're on an income-based repayment plan, and that's what 175, which is kind of a nice square. You're making enough that you've got to make a payment, but the reality is it's probably not paying down your balance with the 175.
Not a whole heck of a lot. Yeah.
You have a wife. She's not that expensive, but you know, about 2 years ago, let's say you got a credit card at Jared, and you're paying $75 a month on that, and you like to have a little extra spending money, so let's say you got a second credit card, and that's $50 a month. All right,
Okay.
so
Pretty reasonable.
we've got not too much standard profile. We've got card payment, student loans, credit card, and credit card. That's about what I see 90% of the time. Pretty
Okay.
basic kind of cost. Nobody's really, now some people will be a little bit lower or higher,
Yep.
but this is just a great example. So with that buying, like with this scenario, 62,000, these monthly debts, you're still going to qualify for a $300,000 house at a 4% interest rate. All right, and we're just going to give you, let's just say, 4% interest rate, 300,000 home, and this not saying you want to spend 300,000, but this is kind of saying maximum debt to income. This would be the maximum you can afford.
Right now, what is Fannie letting you get away with on debt?
So debt to income, total debt to income is we can get all the way up to 49.999. We have to stay under 50%.
Okay.
Now the key is to get to that, you know, this person right here has to be doing a good job. So we'll say they have a 720 credit score.
Okay.
So fair enough.
All right.
So we're at 300. You saved up a little bit, you know, you've got 5% down, which would be $15,000. You know, so now you're going to be financing $285,000.
Okay.
All right, so what does that look like? So there's a couple of things. You know, just plugging some square numbers. Again, we're at 4% interest rate. So let's say, you know, 4% on a 285 loan is going to be roughly $1,360 a month for your principal and interest payment.
P&I.
P&I. But we need the TI
The
too.
TI too, yes.
You know, so let's so your insurance, let's go at a 300,000, 120 a month sounds pretty
Yeah,
reasonable.
that sounds reasonable.
You know, maybe a little bit on the conservative side.
Yeah.
But it's not going to be much lower than that. And let's just say your taxes are 300. But what are we not? We're missing one piece on this. We only put 5% down,
Right.
4% rate. So now we have
Yes,
mortgage
mortgage
insurance too. And this is something that's really important because I've noticed a lot, and I love Zillow. I'm not going to talk poorly about Zillow or anything.
I will.
No. But this is one of the things that they don't do very, very well. Is on every house they talk about what's your payment. But you know what that does? They give you this number.
Yes.
And that number is not accurate.
Correct.
So you go, I can buy a $300,000 house.
Is that kind of like their Z estimates?
I don't know. Apparently not accurate. So you got that. We do the quick math, right? I'm doing math, right?
Yep.
Another 8. So you got 1885.
Okay.
And this is going to put your debt to income. It's going to be over 49.5 on the back end.
Okay.
You're pretty much maxed out,
You're
right?
maxed out. You're not going any higher.
This is assuming no HOA because that's a
That's
factor you
true.
have to evaluate
That's
too.
true.
So
Yep.
this is 4%. So we can't go to 4% today.
Right.
We can get it back in January, if you remember. We can't get it today in July. So what does it do if my rate goes from a 4 to what the current market is? So let's say I'm super, super picky, and I just couldn't find what I liked.
Yep.
At 300,000. Now we're at a 4.75. So what happens is that principal and interest payment adjusts because now your principal and interest goes up. But what actually happens is to keep a similar payment to qualify within your debt to income.
Yep.
You just dropped your buying power all the way down to $275,000.
Okay.
So what does what is $275,000? That $25,000 difference between, a decent kitchen, or my wife's dream bathroom probably would cost $25,000. But what is that going to do nowadays? Like, you just over 6 months, 7 months time, you lost $25,000.
$25K. $25,000 in purchase power. That's huge. That's really big. And I'll tell you a place where I've seen it. In the past several months, we've had the opportunity to sell a couple properties in Sweetwater.
Okay.
It's actually by where I live. And they're a little bit older homes.
Big yards.
Yeah, big yards. Love it. Absolutely love the area. But what you saw is back in the early part of the year, these 4-bedroom, 2-bath homes, 2,000 square feet to about 2,500 square feet, starting out between $350,000 and $400,000. Well, all of a sudden, if you look at Sweetwater and the number of price reductions they've had over the past couple of months, it's numerous because people had to bring it down. Sellers were pricing homes for the 4% market. Stretching it. Everyone's, it's unfortunate, and one reason why I asked you to do this, and the reason why I'm doing this, is I hate the 30-second soundbite. Freaking hate it. Pisses me off. And I really look at this as going beyond the copy. Really getting into what affects you as a customer, as a client. Because when we just sit and look at the 30 seconds, the Orlando Realtors do a great job. They put out a monthly video. But if you look at the numbers that they put out currently, it looks great. Whoa, median price from last year, June of last year to June of this year, you had a 7% increase. That's fantastic. Yeah, it sounds great for long term. All right, but let's look at the other numbers. Percentage of sales, down 11%. Pending sales, down 12%. New listings, down 11%. Inventory, down 17%. So you're getting conflicting information. One part makes it sound like, wow, that's fantastic. The other part, you're looking like, wait, those are some pretty big negative numbers that we're sitting on there. And what's the key? Interest rate average, 4.61. And then just when I look at numbers, and we get the Orlando numbers every month, one of the things that I always look at is original price versus sold price.
And so what they listed for versus what someone is actually willing to pay.
Because unfortunately what happens a lot of times, again, with Zillow and some of these other ones, all you see is the final list price, not the original list price and any price reduction. So so I started the house out at $390,000. That was great. No hits? Well, let's drop it to $375,000. Whoops, no hits? Let's drop it to $350,000. Oh, fantastic. We sold it for $349,000. So what does this look like? Well, we sold the house at 99.9% of listing. No, you didn't. No, you didn't.
Of the current list price.
Of the current list price. It's not the real number. So one of the things I did is I pulled the chart going from January of this year until July of this year. Here's the interesting thing. The original median price in January was $224,000. These are Seminole County numbers, just to let you know. I pulled just for Seminole County.
Just
Seminole. July of this, or the July numbers for this year, median price, you think has gone up?
It said 7% was what we saw.
Yeah. So would you think you would have?
Maybe 230?
No. 225. Median price is actually stabilizing. We did see a spike back in May up to $233,000. But since May
was when this piece
started to pop up. Right.
January was here, then it goes up a little bit, February, March, April. Then May, all of a sudden, it's
It took a spike. Yes.
4.65, then 4 point. It's
Right.
just boom, 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 really gone
Yeah.
up. And that's a lot of that is not because banks are getting greedy at all.
No.
It's because the economy is actually getting stronger, which
Exactly.
people don't like to hear that interest rates are going up. But it's actually a good thing because when it was held at the 4, or if we go back further in time and it was in the high 3s and such, it was actually not good at all. Like it was great for our wallets,
Oh,
for our
fantastic
buying
for
power.
us. We loved it.
But as the economy, as the entire nation, it was saying, hey, we weren't doing well because
Exactly.
the government was floating rates, they were compressing rates. And
They
keeping
were
them down.
artificially low.
They were basically giving a penicillin shot to the housing market.
Exactly. So those days are over. We've got to normalize rates. I think the Fed actually is doing a good job of doing it slowly.
Yeah.
But you are still getting that mental breakdown where people are just saying, whoa, for a second. So let's look at this. May, we were at 233,000 median. Okay. June, we're at 229,900. And then July, we're sitting at 225,000. So these are the median original prices. So we've actually tightened up, the market's tightening. So for sellers, you've got to look at this and go, ooh.
Can I ask a question?
Sure.
And this might just be the ignorance of being on the mortgage side and not the real estate side. But isn't this peak buying season? Isn't this when most people are buying, which doesn't that mean this should be going the other way, right?
Yeah. Well, here's a very interesting thing. This is the geek in me, because I am a geek. If you looked around this room, you would realize I'm a geek. All right? I went on to some of the top local realtor web pages. I'm not going to tell you who they are, but I'll tell you I did. And their bell curve for web traffic looks like this.
Ooh, so this is now.
This is now. This was May. Their hits total average about 14,000. And this is a great parameter for the real estate market. You know why? Because 95% of people start their home search on the web. Mm-hmm. So you watch, one thing I always do is I watch the web traffic. Because you can tell how the market is also based on the web traffic. Well, this is now July. And they dropped down to under 6,000 web hits. And that's 4 or 5, I can't remember exactly, 4 or 5 different very good realtor-based web pages here in Orlando that are locally based. So again, here it is. Matches up to these numbers. Mm-hmm. Now here's another interesting number that I love. Is I took a look at the difference from the original price median versus the sales price median. Well, in January, the difference was $34,000.
So original list price to what they actually sold for,
right?
$34,000.
So this was sitting at 224 median. The median actual sales price was 190,000.
So was that meaning that on average people were overpriced 34,000?
Yeah,
right.
Slower market. So what happens in a slower market? You try and get a bigger discount off of the list price, which makes sense.
Yeah.
Okay. Well, what's now in July? We're at July. The difference is $12,000. Tightened up immensely. So you've got a 225. Nice numbers. Yeah. 225,000 median versus a 213,000 sales price, so $12,000.
So, and what's kind of causing this? Like, clearly the market's gotten a little bit. Is this because it's gotten better, more quicker?
Well,
Is it because they're priced better?
to me, it's a couple things. One, they're priced better. If you notice, our line really looks like this now as far as price increases in homes. All right? So we've leveled off, we've really kind of leveled off on the prices. And actually, the past couple months, the median's come down just a hair. So the sellers are learning that, hey, I can't overprice the houses. If I price it right, I'm going to get closer to what I'm looking for, what the real true value of the house is.
So
And-
we can't dream too big.
Right, and then the buyers are realizing, okay, it is competitive. The inventory is tight. So yes, am I going to have to pay closer to what they're asking for that house? Yes, I am. So the details in the data, when you break out the numbers and get beyond that 30 seconds sound clip, there's a lot of information in there. And when you're looking to price a home, you got to look at these things.
Absolutely.
You know, when you're looking to buy a home, you want to know this type of stuff. Okay, for this subdivision, let's take a subdivision, Sweetwater. How many price decreases have they had in the past 2 months? You know, what's the tendency within that subdivision? You know, what's the tendency within that town? So I think what we're going to see really over the next probably 6 months is we're going to see this, even though the inventory is still tight. You know, we've only got, I think, 7,700 or 7,500 homes, you know, on the MLS. So even though the market is tight, because people's wallets are going to be tighter, you're going to see this number, this difference stay tight, and they're going to be much pickier because you've lost $25,000 in purchasing costs.
I really just want, I feel like this is huge because if you sell a house, right, what do you almost 95, 99% have to do after that?
Buy another house.
Buy another house. So you just listed in January, and then you lost 34,000 as you went through this, right? And then you lost 25,000, you know, on your purchasing power. So you really lost 59,000.
Where's the
You gotta go to the camera person. But that's 60,000. Yeah, that's all $60,000 you lost because.
Oh, sure. Yeah, I understand.
You kind like this is the challenge right there. Is you were trying to get as much as you could. Maybe you didn't listen to the professional that was telling you where the values are and how, because your goal as a realtor is what? Is to sell it for the most, and you
always want to get the best value for your client. You know, you want to maximize the value, but sometimes I'll tell you one of the hardest things for a lot of realtors to do is to actually look your client in the face and say, yeah, I know you've got the nicest kitchen, you've got the nicest bathroom, you've got the nicest yard, but I'm sorry, it doesn't make that much of a difference in the value. You know, comparables are comparables.
You may have quartz, but the comps have granite.
Right. And it's honestly, one of the hardest things is when, Zillow said it was worth this much.
Use estimate.
Yes, Z estimate. Well, here's the thing. If anyone wants their Z estimate and the 60,000 other automated valuation models to take a look, we sold a house. The Z estimate was $257,000. Gorgeous house. House was redone by one of the best builders in town. And absolutely gorgeous. We sold the house, I think it was for $357,000. You know what the Z estimate changed to? $300,000. I was dying laughing. And again, details. You want to have fun? Go into the back page of Zillow where they hide it and look at their numbers. They came out with their numbers in February 2018. They come out with their numbers all the time. On average, they're off 5%. 5%. Okay, on a $300,000 house, you're 15 grand off. But it's not 15 grand one way. You can be 15 grand too high, or too high or too low. So you really got a $30,000 swing on what the real value of your house is. And this is only for 40% of the market. The other 60%, they average 10 to 20%. I believe it is.
Okay.
That's why we spend so much time doing CPAs and valuations of houses.
So that's why you can't rely on a computer algorithm.
Exactly. Because they don't know. Because what they're doing is they're taking, okay, for instance, your house. So they're taking your house, and then they're going to like Sunrise over on the other side of Tuscaloosa, and because it's in a geographical area, okay, two totally different subdivisions.
Within 2 miles of each other.
2 miles, and they average them out. You can't do it that way.
One's a starter neighborhood, and the
Exactly.
other is a
move up.
established
Yes,
up
a move up neighborhood. Exactly.
So I mean, I think these numbers are powerful, and I don't want to leave. And you know, the design here is not to sit there and scare anybody or and be
Correct.
negative. The goal here is to give you a little bit more knowledge and a little bit more power in understanding what is happening. Because guess what? That 4.75 we talked about it's not stopping right there.
No.
You know, they're projecting over 5 by the end. The feds have already announced another
4 more, at least 4 more, or 3 more.
They're projecting at the start of the year. They said 3 rate increases to the federal funds rate, which is basically it's what the government gives banks to borrow money overnight. So
Okay.
it's kind of a roundabout, simple explanation. So if that goes up, if the government charges banks more money, banks are going to charge consumers more money. So what happens is that's what kind of drives this. Is a big piece. It's not the only factor, but originally at the start of the year they projected 3. Now they're saying 4. We've already had 2, which means there's another 2 more for the year.
Yep.
We're going to be over 5. And the reality is a stable economy should be at a 5.5 to 6, right in there.
Our GDP number, which is supposed to come out next week, is projected to be something we haven't seen in years. 4%. That's a boom.
Yeah.
That's a boom. 4% is a boom. So everything is pressure on all interest rates is going this way. What may hold them now? Europe, China,
Other markets.
other markets. Because right now, the U.S. is the only booming economy. Everyone else is struggling.
What's nice about this, though, is the economy is booming. And what I'll say here is we're not seeing housing market go up
Right.
like before. It's gone up a lot, don't get me wrong.
Yeah.
But the key is like when a lot of people talk about the previous housing collapse, the recession, everything that was started because of housing.
Yep.
And you've noticed we've tightened up underwriting, appraisers.
Oh, yeah.
As a loan officer, I just can't call an appraiser and say, hey, I need that value at $300,000. I'll take you to lunch tomorrow. No, it doesn't. Now, maybe 15 years ago you could do that.
Yeah.
You know, during the boom, you could do that. You can't do that. Like I can't even talk to them anymore. I have to go through an appraisal management company.
Exactly.
Everything's separated. They've done all these things. They've tightened up how we underwrite. They're starting to loosen up because now we have technology and data that can sit there and go, okay, and that's why when we talked about 49.999, that debt to income, you know, a year ago it was 45%. But they went up because what Fannie Mae found is they looked at FHA and VA and all these other type of buyers that were over 45, and they were like, wait a minute, like being over 45 isn't a catalyst for defaulting on your loan. There's other pieces that are. And guess what? With technology, Fannie Mae, which Freddie Mac, these entities can now look at your file, your totality of your credit file, and they can go, hey, like you have a 720, but we saw that last year you missed 3 payments on a student loan, and then the year before that you missed a payment on a car, and then the year before that you missed this, and then go ahead. We don't like that as much. Whereas before the system was only intelligent enough to go, you have a 720, you're not late on anything now, we're good.
I remember, okay, here's our 3 scores.
Yep.
Oh, we got a 745, a 720, and a 650. Oh, we get to take the middle one. Thank God.
and we still use the middle one, but guess what? Now we take that 650 into consideration. We price off the middle. That low one, now we have to go, why is that one so much lower? So that's where it's changing, and that's what's, that's one of the pieces. The market and housing, these things not rising as quickly as they were. Like
we needed it. Honestly, we needed it. Because I'm sorry, but you can't have 10, 12% appreciation continuously in the market. It doesn't make sense. We needed a little pressure up to help stabilize the market, is what we really need to do. Now, hopefully what we'll see really over the next 6 months to a year is that with this growth rate, unemployment where it is we're going to start to see people get pay increases. I think that's the one thing where we're seeing we're seeing a little bit of lag is the pay increase. But it's interesting. I saw a number the other day. There's actually more people quitting their jobs than ever before. Yeah, man.
Oh man.
Oh man.
Hands rising behind the camera.
And it's because they see opportunity. And there's optimism. It's a nice feeling.
We're no longer looking at life skin.
Yeah.
Or the economy skin.
Yeah. But it's funny because I think there's still a lot of people out there who went through the housing crisis. People who lost their homes.
Yeah.
And they're looking at it now again, and they're a little bit nervous. I think probably one of the next ones we're going to do is, because I've read several articles over the past week, is millennials and others. They're actually starting to feel that renting is better than owning. And long term, I still don't see that. I don't see it. That's not the American dream. It's not. And I think that's something we need to look at and need to show them. Hey, you still can own. You still can. There's still opportunity out there. But I think a lot of those saw what happened to their parents.
Yeah.
At the crash. Mm-hmm. And now they're at that age, and they're like, "Well, my parents went through this." It kind of reminds me of my grandparents, because my grandparents were very frugal. My grandparents went through the Depression, and anyone who's my age, 18, 19, anyone who's my age, their grandparents, who went through the Depression, they had all their money, and they never lived beyond their means. And I think we're seeing a little bit of that with the millennials. Is they're enjoying life, but they're not stretching it. They saw what happened to their parents.
Absolutely. So I think that's a good teaser to let off for. You're definitely going to want to stay tuned for the next one. Get Joseph Dionne with Home First Lending.
Brendan Rendo with the Homes in Orlando team at Next Home Neighborhood Realty. Thank you for your time today. Hope we taught you something.